Good afternoon. Good afternoon. Thank you very much for joining us today. I am Bill Kaler. I am the CEO of Team NEO, and really proud to be a part of this event today. For those of you who don't know, there are a number of Team NEO friends in the group today, but for those of you who don't know us, we're an economic development here in Northeast Ohio that is focused on encouraging growth through business investment and doing it in a way that not only focuses on growth, but also doing it in a way that encourages us to build a more prosperous, vibrant community where more people can participate in the growth that we create together. We do that through projects involving state and local incentives and arranging those and any number of things related to site development and encouraging talent development and things of that nature. All of that is as background because I'm really excited about what we're going to hear about today. So from President Mester, as I look at the Northeast Ohio economy and how it is positioned relative to its position over the many years that I've actually done work in Ohio, I actually grew up in Ohio, I think there's no better time to be in Northeast Ohio right now. There's a ton of opportunity. The economic development system, the public sector leadership are very much aligned. We learned a lot in the pandemic. Some of the more positive things that we learned in terms of the economy, from my perspective, is that we learned that we need stronger control of our supply chains. We've learned that there's a connection between economic success and national security. We've learned that there are opportunities to bring more technology home in the businesses that we have, and there are different ways to use those technologies to make our businesses stronger and better able to compete. If you think about Ohio and you think about Northeast Ohio, that's all here. The third largest manufacturing state in the country, as the economy that Northeast Ohio is, 30% of that, we're a driver. And so I get very excited about the opportunity, but we've also learned that the growth opportunity itself is not enough. We've got to think about the communities we have, the communities around us, the vibrancy of those communities, because if we grow for the sake of growing, but we don't create communities where more people are properly prepared, we were talking about the talent situation. If we don't do that, then we're not going to be able to compete and take advantage of the opportunity that's there. So that's what we do, and that's why I'm very excited about the work that is being, the conversation we're about to have today. I appreciate the role that the Cleveland Fed plays in the system, but also in Northeast Ohio, not just thinking about the financial system as it is, but the data and the insights that we receive around community development, around the commercial activity in the community, the Beige Book and so forth. The Cleveland Fed is known for that, and we rely as a partner in a lot of the work that we do from a data and research perspective with many of the folks that are here and work in this building. And I also appreciate the orientation of NABE, the National Association of Business Economists, driving strategies that are data-centric, that are focused on application of research into to make differences in strategy is really what we rely on every day. So thank you all for being here. That's why I'm excited. I hope you share that. And as we hear the conversation, we'll look forward to a really interesting set of insights. With that, I'm going to introduce David Altig, who's a member of the Atlanta Fed, to take us off from here. Thank you for being here.
Well, I want to thank you for being here, too. Feels like Northeast Ohio is the center of the universe this week. It's the eclipse, the women's basketball tournament, and as a graduate of the University of Iowa, I have a particular rooting interest in that. And then to complete the trifecta conversation with President Mester. I do want to, I will later on kind of close this out, and I will kind kind of asked the Cleveland Fed folks to be acknowledged, but I want to call out one person in particular, Lisa Barrow, sitting in the back there. Lisa is a fairly newly arrived member of the Cleveland Fed and in charge of outreach and regional analysis. I'm sure you have all heard this before, but for all of us who work in the Federal Reserve System, you out there in the community making the decisions that make the community go are the absolute lifeblood of the stuff that we do. Your input is invaluable, and I've been at this a while. I can guarantee you that from your lips go the words to the ears of the Federal Open Market Committee. So very much appreciated. Say hi to Lisa if you haven't already. Give her your business card because we'll be trying to hunt you down so that you can help make monetary policy as well. I'm going to forego sort of the usual bio. I have it on good authority. The Wikipedia page is pretty good. If you look up Mester, you'll learn all about sort of the formal stuff. I just want to introduce Loretta as a friend, as one of the most influential voices on the Federal Open Market Committee. When President Mester speaks, people listen. She's a tireless advocate for the community of the 4th District and really exemplifies all the things that make those of us who toil within the Federal Reserve proud to be associated with the institution that we are associated with. So please welcome to the stage President Loretta Mester.
Well, that was a wonderful introduction. Thank you very much. And thank you very much for pointing out the important work going on in Northeast Ohio. I agree with you totally. This is a great place. There's a lot of good activity going on. It's an exciting place to be, and not just this weekend with the things that Dave pointed out, but there's a lot of really good work going on. And the Federal Reserve Bank of Cleveland is really proud to be part of it and to help sort of further the work and inclusivity of our economy. So I'm really appreciative. And it's a real pleasure to welcome you into the bank. You know, it was great to start having events after COVID and bringing people into the Federal Reserve so that we're less enigmatic and people can see what we do. And I really appreciate it. And for all of you who are on our Beige Book contact list, thank you. And for others who haven't joined us yet, we do welcome your insights, because it really does help us make monetary policy. And I can't say enough how appreciative we are really hearing what's on the ground, what's going on Main Street, what's going on in our communities. It really helps us think about the economy, what's to come, and making sure that we're setting monetary policy to really foster a strong economy for everyone. So thank you. Dave and I go back a long way, as he said. Perhaps I shouldn't even be pointing that out. But we worked together when we were both research directors. Dave was at the Atlanta Fed. He's still at the Atlanta Fed, and he was research director there, and I was the research director at the Philadelphia Fed. So we got to know each other pretty well, working on many things in the system. He's a first-rate economist, so I know I have my. I know he's going to give me a great moderated discussion, and he's going to keep me on my toes. So thank you, Dave, for that. Now, before we get into the question and answer portion, which is the fun part of the day, I thought it might be helpful to frame the discussion we're going to have by offering a few brief remarks about the economy and monetary policy. And I'm going to start by reminding everyone that what I say today, both in the prepared remarks and also in the conversation, will be my views and not necessarily those of the Federal Reserve System or my colleagues on the Federal Open Market Committee. So let's turn to the economy. So substantial progress has been made on inflation since inflation peaked in 2022. And that peak was in the range of 7 to 9%, depending on how you measure it. But if you look at where we are today, even though we've made progress, inflation is still above our 2% objective. PCE inflation is now running about 2.5%, whether you measure it year over year or whether you measure it over the past 6 months annualized. And core PC inflation is running about 2.75% measured year over year and near 3% annualized over the past 6 months. The monthly inflation readings for January and February came in firmer than the readings over the second half of last year, and I think they're a good reminder of what we already knew, that the disinflation process won't be a smooth path back to 2%. Now, in my own view, I don't think the inflation picture has changed very much since the start of the year, because I'd already thought that the pace of disinflation would slow down this year. I continue to think the most likely scenario is that inflation will continue on a downward trajectory to 2% over time, but I need to see more data to raise my confidence. Some further monthly readings will give us a better sense of whether the disinflation process is stalling out or whether the start of the year readings reflect a temporary detour on the downward path back to price stability. I don't expect I will have enough information by the time of the FOMC's next meeting to make that determination. Now, a remarkable thing about the disinflation is that it's occurred in the midst of strong labor markets and economic growth. While the broader tightening in financial conditions over time has led to some moderation in the growth of output and employment, both have remained stronger than expected. And that relatively strong demand confronts the supply side of the economy that's healing. Supply chain disruptions and bottlenecks have improved over the past 3 years, and the labor market is normalizing. People have returned to the labor force over time, and immigration has also increased the supply of labor. Now, with imbalances between supply and demand in both product markets and labor markets easing, inflation has been easing as well. Now that the pressures on supply chains are approaching normal and the labor market is coming into better balance, we're not likely to get as much help on inflation from the supply side as we saw last year. So I've raised up my projection for growth for the year based on incoming economic information, including the official statistics, but also those reports that we receive from our directors on our board of directors, and Heidi Gartland, our chair of our board, is here, and also our regional contacts, you in the audience, as well as our prospective new Beige Book contacts. And that information is really crucial because that's forward-looking. A lot of the statistics we get are backward-looking. The information we're getting from business and other contacts in the district is forward-looking. So in the most likely scenario, I still expect growth to moderate compared to last year's very rapid pace. But instead of the economy growing under trend this year, I now expect it to grow a bit above my 2% estimate of trend growth. I expect the labor market to continue to come into better balance this year, with a slight uptick in the unemployment rate from its current very low level. And I expect further progress on inflation, but at a slower pace than we saw last year. Now, if the economy evolves as expected, then in my view, it will be appropriate for the FOMC to begin reducing the Fed funds rate later this year as inflation continues on its downward path toward 2% and labor markets and economic growth remain solid. Now, these reductions should be viewed as a normalization of policy back to a neutral level as the economy returns to price stability and maximum employment. But of course, the actual path policy takes will depend on how the economy actually evolves. Now, my forecast is similar to the median among FOMC participants in the summary of economic projections that were released after our March meeting, except I see somewhat higher inflation this year. Also, in my projection, I've raised my estimate of the longer run federal funds rate to 3%, compared to 2.5%, which had been my estimate for some time. And I raised my estimate to reflect the continued strength and resiliency in the economy despite high nominal interest rates and higher model-based estimates of the equilibrium interest rate, the so-called R-star. Now, I've been discussing my view of the most likely scenario, but there are several risks to the forecast, including continued heightened geopolitical tensions, slow growth of the Chinese economy, potential deterioration in conditions in commercial real estate markets, renewed stresses in financial markets, and on the upside, the possibility of stronger than expected productivity growth. Now, at its meeting 2 weeks ago, the FOMC decided to keep the target range for the Fed funds rate at 5.25% to 5.5%, and reiterated that it doesn't expect it will be appropriate to reduce the target range until the committee has gained greater confidence that inflation is moving sustainably toward 2%. Now, with inflation moving closer to our goal, the risks to achieving both parts of our mandate have become more balanced. Now, when we were tightening policy, we really needed to focus on the inflation part of our mandate because inflation was so high and the labor market was strong. Now, risk management with respect to both parts of our mandate will need to be the hallmark of monetary policy decisions going forward. If year-ahead inflation expectations continue to decline, maintaining the current level of the nominal Fed funds rate for too long would effectively be a tightening in our policy stance, which would pose an increasing risk to the maximum employment part of the mandate. On the other hand, moving rates down too soon or too quickly without sufficient evidence to give us confidence that inflation is on a sustainable and timely path back to 2% would risk undoing the progress and the good progress we've made on inflation. At this point, I think the bigger risk would be to begin reducing the funds rate too early. And with labor markets and economic growth both being very solid, we do not need to take that risk. Now, our current monetary policy stance puts us in a good position for managing risks that can manifest themselves on either side. If labor markets deteriorate, we can move rates down sooner and more quickly than in our baseline. Rather than view that as normalization, the intention would be to return to an accommodative stance of monetary policy to support the economy. On the other hand, if inflation appears to be stalling at a level above our goal, we can hold our restrictive stance for longer than in the baseline. Now, in contrast to where we are now, our policy was not well positioned when we started our tightening cycle because the policy rate was so low and inflation was moving up persistently. We needed to raise rates fairly aggressively. At this point, what we're trying to do is to calibrate our policy well to economic developments so we can avoid having to act in an aggressive fashion. And indeed, if the economy evolves as I expect it to in my baseline forecast, I anticipate that we'll be able to move rates down gradually as inflation and inflation expectations move down, allowing us to continue to manage the risk to both sides of our mandate. But let me reiterate, the actual path of policy will depend on how the economy actually evolves. So the FOMC job continues to be to assess the implications of economic and financial developments for the outlook and the risks around the outlook, and given that assessment, calibrate monetary policy so that inflation returns sustainably to our 2% goal and labor markets remain healthy. So that concludes my brief summary of my outlook and where I see the economy, and I'm really looking forward to the conversation that we're going to have. Thanks.
I knew I would forget something, and I forgot to tell you that there are these note cards on your table. So please, if you have questions, write down your questions on the note cards. Who's going to raise your hand up, and some of the crack staff at the Cleveland Fed will come by and collect them and deliver them up to the stage. Okay. Is this on? We good? Yep. Thanks for the remarks. So let me start with a couple things that are confusing me. So I won't implicate you in this, but I think it was pretty clear a lot of us were surprised about the strength of the economy in 2023, and fair enough to say maybe a little bit surprised about the strength of the economy so far this year. To what do you attribute the kind of amazing resilience of the U.S. economy to?
Well, it's always dangerous to count out the resiliency of the U.S. economy, but you're right. I mean, if you think back, over a year ago, most economists were thinking that we would have a slowdown in growth by now. And we just haven't seen that, right? We've seen the economy continue to perform. I think there's a couple of things. One, there was a lot of support during the pandemic for the economy, both monetary policy and fiscal policy, appropriately so. I think people also forget about some of the dire forecasts about when COVID first hit, what could have happened to the U.S. economy. And some of that supported growth going forward and supported growth being more resilient than expected, because that support for the economy lasted, I think, longer than a lot of us thought. We were always looking at, getting information from banks who were on our board about, are deposits running out, or the people, still have a lot of money on hand, and a lot of firms and people did, and households did. And I think that support for the economy has lingered on. The surprising thing is usually what you see is when you have interest rates running up as fast as they did and as high as they did, you would have expected that to have a real dampening effect on the economy. And I think most models would have suggested that. But we haven't seen that yet. I still believe that we're going to see moderation in growth, and we're seeing that happen already. We're seeing that in terms of investment in housing. Yes, recent statistics show that we're seeing some housing starts and some pickup in housing, but if you look over a longer period, that's been subdued, right? And investment has been subdued in equipment and software. So we're seeing that slowdown, and we're seeing some slowdown in hiring, but in a normalization method, not in the economy is, having not a strong labor market. We're seeing rebalancing there. So I do think we're going to see moderation. I just don't think we're going to see it as much as I had anticipated, because I had been thinking this year we would see below trend growth. Now I'm a bit above trend, given what we've seen so far.
So you note that we are not quite where you think we ought to be on the inflation front. So does this strength in the economy just kind of doesn't seem to be abating very quickly? Does that complicate the inflation picture, or no?
Well, I think one thing we have learned is that you can have disinflation happening in this environment without necessarily seeing a big slowdown in growth. And I think that's going to be kind of a characteristics that we have to carry with us. So just because the economy's strong, I don't forecast that in and of itself, right, is going to necessarily mean inflation will stall, or the disinflation process will stall, or that we'll see inflation resurge. But certainly you look at that and you have to put that into your calculus and what's happening in the economy. I mean, the other thing is, as I said in the prepared remarks, is I have raised what I think the long run interest rate is, which normalizes the economy. And I think that may mean that, although we've raised interest rates quite a bit and they're at a high level, maybe we don't have as much restraint on the monetary policy side as we were thinking either. So to me, the key is I want to see more evidence that inflation is coming down. I don't expect it to come down as fast as we saw in the second half of last year, but I still want to be more convinced that it's on that sustainable downward path. Yeah, there'll be bumps in the road from month to month, but we need to see more evidence that that's going down. And if we get that, then I would be comfortable, thinking about starting to normalize the interest rate back to something that's getting down closer to a more normal level over time.
So you don't think that we're returning to the pre-pandemic experience of extraordinarily low interest rates for a long period of time?
Yeah. I mean, I don't think the equilibrium interest rate is going to be as low as it was for a number of reasons. And we know that there's going to be investment that's needed going forward. And I think that investment will actually raise some potential growth in the U.S. and across the world, right? The people are making investments in climate, to control climate. People are making investments in AI. People are making a lot of investments, right? And that investment, I think, means that we'll have a higher interest rate. There are demographic factors that would push down the equilibrium rate. So where it equilibrates, I don't know. But I see my estimate is I've raised it to 3%. Maybe it'll end up being higher, maybe it'll end up being lower. But in the period of time that we're talking about, I think it'll be elevated.
So I take it that's a fairly optimistic reason that you think interest rates are going to land a little higher than they were prior to the pandemic, growth and productivity and...
I mean, I take the optimistic view. There are other reasons that you might think they might be higher, like debt levels across the world. But all these factors feed into that equilibrium. So yes, there could be not as positive reasons, but there could also be positive reasons.
Well, sort of speaking of debt levels, a question of, although it's clear that we don't want to comment on fiscal policy as part of the part of our responsibilities are elsewhere, but so when you think about things like IRA, CHIPS Act, the infrastructure bill, is that part of your story for why you think kind of growth is going to remain in a pretty solid place, and part of the story of why maybe interest rates are going to be higher than kind of what we've experienced?
I mean, there's great potential that I think it's clear that we need infrastructure spending in the U.S. I think we've underinvested in that. And the potential of those acts to add money to actually support communities that are building, I think, are important for the growth story going forward. So, I look at that as investment, right, that can have a return, a positive return in terms of the productivity of the U.S. economy and the potential growth rate of the U.S. economy, and therefore a higher equilibrium interest rate going forward.
So let's think about this growth picture a little more, and its connection to sort of the kind of the inflation picture as well. So you got a couple questions here having to do with, as you kind of project forward, what parts of the economy feel to you like they are going to remain perhaps quite robust on the spending side? Is the consumer going to hang in there? Is the consumer not? Is these fiscal policies going to have an outsized impact? But then on the flip side of it, what's housing inflation going to look like? What's consumer kind of food prices and the things people seem to care about going to?
Yeah, I mean, so let's look at housing, right? A very interest rate sensitive sector. What we've seen is rents have come down. If you look at the components of the CPI or the PCE housing index, that's one of the ones that has been stubborn in terms of not turning down as much as we might have thought it had. But if you look at rents, and we do work here that looks at measuring rents and new leases, right? Those indicators all point to that housing inflation will begin to come down. And so that's something built into the forecast, that the expectation is that'll come down. The most sticky part of inflation typically is the services, core services part of inflation, and that we have seen that start to come down. Again, not as quickly as we saw good prices come down, but again, that's moving in the right direction. And goods prices, before the pandemic, right, there was negative inflation in good prices. Then during the pandemic, of course, we saw that change. So that distribution of where the price increases is coming from has changed over time. But we need to see continued progress on all parts of inflation to get the total inflation down. And my expectation is we will see that. In terms of strength, I point to the district, right? If you talk to manufacturers in our district, it's a mixed picture. Stable conditions in many, but others are saying they still have orders coming in and they're seeing a pickup in activities. Similarly, households seem to be doing quite well. There are signs that some segments are a little stressed. If you look at delinquency rates on credit cards, they're starting to pick up. But overall, the overall picture on the consumer side is that it's still a strong consumer picture.
Are you of the belief that the excess savings that we observed over the course of the policies designed to kind of prop up the consumer during the pandemic, you think that's pretty much played out?
So again, I think it depends on the category, but yeah, if you look at the lower income families, right, that there's signs that has played out. And that's why we're seeing sort of a pickup in credit card debt and also credit card delinquencies, they aren't at levels that we would have think would be high or even medium, right? They're still at very low levels when you talk to bankers, but nonetheless, you're beginning to see that. But remember, part of the mechanism here is that we're going to have some rebalancing in both the product side and in the labor market, and this is sort of a normalization of activity to bring supply and demand into better balance so that we can get that last bit of inflation coming back down to 2%, so we're back to equilibrium.
So that last bit, I think you probably answered this question for the most part, but it's because you think that sort of the sticky parts of the kind of market basket, if you will, are the ones that have yet to move, and we need to kind of see that happen?
Yeah, that, but also, if you look at last year, there was a lot of disinflation, which was fantastic. But we had real help from the supply side, right? The imbalances that we experienced over the pandemic and then aftermath, right? The supply chain issues, the disruptions, the bottlenecks, right, which had propped up prices. We've seen a lot of normalization there. Maybe not in every segment being back to normal, but there's considerable progress that's been made. And that really helped us last year in the disinflation. I don't think we can expect to see as much help there. And similarly on the labor market, we've had a lot of people come back into the labor market in terms of workers, right? So I don't really think we can expect the supply side to have as big an impact on that recalibration and balancing between supply and demand. So it'll have to be more on the demand side this year. And I think that probably means we'll see disinflation continue, but not at the same pace that we saw in the second half of last year.
Well, let's turn to the labor market for a moment then. So again, in the category of stuff that seemed incredibly surprising, we saw the U.S. economy create 220,000 jobs a month or so, pretty consistently for the last couple of years, without a whole bunch of change in the unemployment rate, without a large burst of wage inflation, if you will. Maybe you don't like that term, but so what's the story?
Yeah. Well, I'm not sure that all the businesses out there would say there wasn't high wage inflation, because there was an increase in wages. As you know, in the Atlanta Fed, you published the great data on wages. Things are re-equilibrating now. And I think people have to remember that the pandemic was a huge shock to the economy, a huge shock to everyone on non-economic grounds, but in terms of the economic grounds, it was a huge shock to the economy. People left the workforce, right? We had statistics came out, or a study came out just yesterday from the St. Louis Fed about the fact about retirees not coming back. They left early, they didn't come back. So there was a huge shock to labor supply during the pandemic. And then there was a huge demand, right? When the economy reopened, demand went up. So there was this real imbalance in the labor market. We saw wages go up significantly. And now we're getting to the point where things are rebalancing. Now, it's true that the employment growth has hung up month after month stronger than I think many economists thought. But the way it's being normalized, it's a lot of firms saying they're not hiring as many people. So if you look at job openings are coming down, right? They still want to hire, but they're not looking for the same number of employees as they would have a year ago. And so that's been where the mechanism has been. It's more on that opening side, job openings and vacancies, as opposed to layoffs or unemployment. And so we're seeing that rebalancing the labor market without seeing, as you might typically see in the economy in a business cycle, an increase in the unemployment rate. But now that we're getting kind of closer to balance, that's why the Fed has to be now focused on both sides of our mandate. We can't just focus on the inflation part of the mandate, as we had to and we must at the beginning of our tightening cycle. Right now, it's really a balance, right, looking at both of those parts of our mandate and taking them both into account so we can calibrate policy to get back to both price stability and maximum employment. And I think that's going to be the challenge going forward, is that real calibration as the economy gets back into better balance.
So where does immigration fit into the whole labor market equation in your mind?
Yeah. So as everyone I'm sure knows, right, the immigration statistics that were revised and came out a month ago showed that immigration was much higher during this last, several years than we anticipated or than we measured, right? It was a measurement issue. And that really raised the supply of labor. Again, another source of labor, another thing that helped alleviate some of the things that you would see necessarily in a business cycle where things were equilibrating. Again, can we count on the same level of immigration going forward that we saw in the past couple of years? I don't think so. So again, that's going to be another thing, normalizing the labor force. Again, making sure that we look at both sides of our mandate is going to be important.
So normalizing the labor market, so what do you think that looks like?
So so in my forecast, what it looks like is we're going to see some slowdown in employment growth, and we're going to see some slight uptick in the unemployment rate. But remember, we're at a very low unemployment rate. We're still near 50-year, 40-year lows in the unemployment rate. So we'll see I think that normalization will mean that we'll see a slight uptick in the unemployment rate. But in my baseline forecast, I don't anticipate we're going to see unhealthy labor markets. I think we're going to see healthy labor markets continue, perhaps not at the same level of conditions. And when you talk to businesses, I think they also say that it's become much easier to hire than it was a year ago. Wages are still elevated, but not at the same level. So a year ago, firms were saying that they anticipated wage increases would be 5%. Now when you talk to them, it's 3.5% to 4%. So again, that kind of process is going on, and I think that'll continue, and we'll get back to better balance in the labor market. But I anticipate labor markets will remain healthy, if not at the current level.
So let me ask you a framework question. Thinking about the labor market. So there was a pretty substantial change in kind of the way the committee was going to think about kind of deviations from normal a couple of years back. Mm-hmm. Do you feel that's worked out pretty well for us?
So I don't think the framework changes per se changed the way the Fed was thinking about monetary policy during this period, right? I mean, I know a lot of people attributed the change in the framework as sort of guiding the decisions. I think what was guiding the decisions was the fact that there was a lot of uncertainty around the path of the economy coming out of the pandemic, during the pandemic, of course, and then after the pandemic. But we were still focused on trying to set policy to make sure that we would get back or stay at price stability. And when prices started going up, I think the committee was thinking that it was supply shocks, which it was, right? But that they wouldn't be as persistent as they proved out to be. And I think that's kind of the way it did. I don't think that had anything to do with the framework. I think that had to do with sort of looking at the past and extrapolating that in current situations. And what it turned out to be was that this economy was very different than the past. So you need the past to help guide your thinking. But this was a very different economy, and so, we saw those price pressures building. And yeah, we probably were behind, but then we took the action that we needed to take to get the level of the funds rate up to a place where we've now come a long way on that journey. Inflation's not back to 2% yet, but we're well down from those levels, and we've been able to maintain a healthy labor side. So again, I think, this was a difficult economy to navigate, and I think, we use our economists to help guide us. As you know, as the director of research, you've been, so you know how that works. But, in the end, right, I think we're in a good spot now in terms of both where the economy is, but also where monetary policy is, so that we're able to sort of, whatever the risks come, right, on either side, we're well positioned now to handle those risks. And I think that would be, if I had to characterize the achievement, that's an achievement.
Okay, let's turn to financial markets for a bit. That's always fun. So I was watching carefully sort of what's going on in the Fed funds futures markets, and lo and behold, it looks like all of a sudden there's been a change of heart. Having spent the last couple of years, I think, having what looked like a complete disbelief about the Federal Market Committee's willingness to kind of stay higher for longer. Now that appears to maybe even have flipped as of this morning. So, so two questions. One, why do you think there's been this disconnect? And two, does that make your job harder?
The disconnect is interesting. Remember, everyone's trying to do the same kind of work, right? So the Fed, we're looking at the same data, right? And we're trying to say, okay, what is that telling us about the economy going forward, right? So we're all trying to take in the data, financial market data, data on the economy, reports from our directors, reports from contacts in the district, and we're trying to use that data to project out what's going to happen to the economy. Financial markets are doing the similar kind of thing. They're taking in the data that comes. So there's a couple of reasons that you might have a difference in sort of our expectations and theirs. They may be reading the economy differently than we do. And remember, right, when you come out of something as big a shock as the pandemic was, right, your models aren't necessarily tracking. It's very reasonable that you'd have disparate views, right, about what's happening in the economy. And I think part of that disconnect was that. And then they infer back, okay, if that's where the economy is going, right, then this has got to be the path for the funds rate. And remember, the markets are not one person, right? The markets are disparate views themselves. You had a lot of economists saying we're going to go into a recession and it could be a bad recession. You had others saying I don't see any recessionary. And so when the markets kind of parse that, you would get differences in terms of sort of what the appropriate path of policy is. I think what's happened now is as things have normalized, right, you get more common view, I would say, of where the economy is and where it's going. And so you'd expect, I would think, that you'd have sort of more kind of less division and more sort of common view of kind of where the economy is. Not exactly lined up, but at least more in line because they're looking again at the same data that we're looking at. We're in a good position with policy right now. I think they interpret it that way too, and now we can sort of move forward. Now, is it easier when we're aligned? Yes. I mean, I think in fact, if you think back, right, we try to be very transparent as we can about our thinking about the economy. Why do people go out and talk about the economy? It's because we want people to understand where we're seeing the economy going and the rationale for our policy actions or inactions, as the case may be. I think it actually makes policy more effective when expectations are aligned. And so I think it is helpful when we don't have the disparate views. But I take the disparate views as also a signal that we need to be explaining our policies better so that people understand them better.
Yeah, so let's keep on the communications issue. Got a couple questions in here. One is pretty inside baseball question. So deviation between the CPI and the PCE and measures of inflation, and of course, public in some sense sort of focuses often more times on the CPI than the PCE inflation number that the Fed is focused on. So there's a divergence. You talked about the divergence in the rationale for potentially cutting rates between something that is sort of defensive versus something that is offensive if the economy begins to soften. So how do you think about these communications problems and how do you solve them?
Well, I think communications are very important. I think that, if you look over time, right, back in '92, we weren't even publishing, we weren't even telling the markets what the action was, right? There were no statements. You had to infer from what was happening in financial markets. Oh, I guess they raised interest rates, or oh, I guess they left them the same. We've come an incredible long way from there, the Fed has, right? There's the press conference after every meeting. There's the statement. There are the minutes that get released. And I think all of that has helped. We have the SEPs, that Summary of Economic Projections. I think these are all very good developments. I know sometimes the Fed is criticized because you have all these people out talking. But I do think it's improved sort of the understanding of what the Fed is thinking, our goals, what their rationale for their policy actions are. Yeah, there are certain things. Technically, we prefer to focus on PC inflation for technical reasons. Our goal is in terms of that. But if you look at sort of the trends in both the CPI and the PCE, they've been similar. And we look at all the inflation statistics. We publish a lot here. We have a Center for Inflation Research. We publish the median PCE inflation measures and others. And all those numbers, right, give us a sense of where inflation is going and helps us forecast and then calibrate our policy. So again, I don't see necessarily there's a big disconnect between inflation. I think everyone agrees that high inflation is a real burden on the economy, and especially a real burden on lower income people. And it's particularly in this cycle, because in this cycle what we found was the highest rate increase, or inflation rates, right, were really on those essentials, which of course, if you look at sort of what do people buy, right, lower income people spend a bigger portion of their budget on essentials like food and energy and need to get to work. So again, this was a particularly painful episode. And I think that's the message coming out of this is it's not like the technical differences across. It's really, can the Fed send the message that we are focused on getting inflation back to price stability and trying to do that in a way that maintains healthy labor markets.
So there was a question, maybe you've answered one of the questions in here, which is the seemingly dour attitude of much of the public about where we are in the economy, given sort of some disembodied view of the statistics. Do you think it's because it's just hitting some particular places which are especially painful for consumers, for example?
So I definitely think that's part of it. Actually, if you look at the more recent surveys, there's been some improvement in sort of people's attitudes, households' attitudes about the economy. But I also think it's like we had very high inflation rates, very high for the U.S., higher than people had experienced, many people had experienced before. And yes, we had nominal wages going up. I mean, talk to any business person, they had to pay those wages, and it was hard for them, also struggling. But if you look at sort of like the increase in the prices, right, and the increase in the wages, we still haven't gotten back, right, and this is based on aggregate data, to have made up for all the increases in prices. So again, I think, if you talk to the average family, which we do, when we go out, right, they're still struggling. And it's not like they made it all up in higher wages and therefore it doesn't bother them that the prices that they face at the grocery store or buying gas are high, right? And until we kind of get that back calibrated, I think we're going to find that there are some families who don't feel as well off as they did before. And I think that's part of it. But again, I'm hopeful that we're going to get back to a place where everything comes, we get back to 2% inflation over time. We have the labor market remain healthy. We have wages continuing to go up, if not at the same levels we saw earlier, at a good pace, so that we can get back to everyone having the view that, okay, I'm in a pretty good spot right now. We're not there yet.
So let me go back for just a second to this observation you made about the kind of distribution of beliefs in financial markets. There's a distribution of beliefs on the Federal Open Market Committee as well. Do you ever wish that people would pay less attention to the median dot plots, for example, and more attention to the differences of opinion?
That's a really good question. I do think one of the benefits of the summary of economic projections is that you can track over time the differences among participants, but probably even more important than that is the change from one set of forecasts to the next. I think there's a lot of information in there. Yes, what is markets, and a lot of the press focus on that median because it's a summary statistic, we know that. But if you think about the last set that were at the end of, at our last meeting, when it was released on March 20, right, there was a content in there that did say, okay, the median dot plot still had 3 rate cuts for this year expected if the economy evolves as expected. But there was a shift in those distribution, right? And so you could see that there were a number of committee members who shifted their views on policy, right? And, instead of 3, they were thinking 2. So even though the median stated 3, there were fewer participants who had more rate cuts built into their forecast, and some that had fewer. And that's significant because that actually showed that the participants did take into account the data that had come in over that intermeeting period, right? So they took it in and it affected sort of their forecast for the economy and therefore their forecast for interest rates. So that's content, I think, that helps tell the story. The chair often says we're data dependent, right? I think those dot plots and the SEP shows how the data does influence views of policy. Now, as I said a couple times in the prepared remarks, those aren't really like, this is what we're going to do. These are, if the economy evolves as you anticipate, what do you think the appropriate path of policy is? But as we all know, the economy may not evolve as we expect it to. There's risk on both sides. And so how policy really evolves is going to really depend on how the economy evolves and what's the implication of that evolution for achievement of our dual mandate goals. And that's sort of the work going forward, is balancing those risks, setting policy, right, and then making sure that our policy is really productive in getting us back to price stability and maximum employment.
All right, let's talk banking.
Okay.
We're about a year down the road from a pretty significant event. What do you think we've learned in the year since SVB challenged us?
It's a good question. I think one of the things we learned is that money can move very, very quickly in this environment. And that was something that, even though intellectually I think we all knew because we knew what was happening in terms of digitalization, I think that was a illustration of how fast a lot of money can move in a very, very short period of time. There's a lot of work going on within the Federal Reserve System to make sure that institutions that have access to the discount window are prepared to use the discount window. So a lot of work going on to making sure that depository institutions have the legal agreements in place, that they're up to date, that even mundane things like contact information is there, and that they have collateral already pre-positioned so that if an event happens, they can come in and get discount window lending. There's also work going on to sort of make sure that reserve banks are better and have better contact between the Federal Home Loan Bank system and the Federal Reserve banks. Here we've had that relationship. We have Pittsburgh and Cincy have Federal Home Loan Banks. We've had those relationships. But one thing we learned is that not every district and not every home loan bank necessarily has that kind of relationship with their reserve bank. And that was particularly important in the events that you were talking about, because the handoff, between the home loan bank and collateral and the Fed, right, could have run more smoothly. So again, I think there's a lot of good work going on. And there's work going on about how to sort of modernize the discount window. As you well know, and as I'm sure the bankers know, the discount window has been afflicted by stigma. Firms don't necessarily want to borrow at the discount window, but when the time comes, right, we need them to be willing to come in and get the liquidity they need, because these kinds of liquidity problems can propagate across the whole financial system. So again, there's work going on to ensure that depository institutions know we're here, we're willing to lend and on good collateral, and they should have their collateral pre-positioned.
So a big part of that story, as everyone was sort of aware of, kind of was about commercial real estate, and the changes in that sector really in many ways wrought by the pandemic and behavioral changes in the aftermath of it. So how do you think about kind of how that sector is developing? What's sort of the outlook for commercial real estate feel like to you? And do we feel like whatever issues are out there are manageable within the context of the financial system?
Right. So that was one of the issues of the commercial real estate. You know, a lot of it was financed when interest rates were very low, and some of it would be coming up for renewal at much higher interest rates. So if you were to market some of those portfolios, you'd find that they took losses or would have to take losses. I think it's manageable. Of course, banks are doing, you know, their risk management. Partly it's manageable because a lot of the contracts over time, so that it's not just everything comes due at one time, right? It's going to be a several year renewal process and reinvestment process. The longer run prospects, of course, are again colored by what happened during the pandemic and what's happening in particularly downtowns. And you have a mix of things. You know, remote work means that probably you need fewer office buildings, or at least as large of office buildings. On the other hand, people seem to want to be downtown living. So there's going to be sort of a change, I would say, in terms of the kind of composition of what you might see in urban settings. And at the same time, there's a true shortage of housing in the country. So again, you know, I think that we're going to see a mix of different kinds of construction. But right now, when you talk to bankers, at least and we analyze the data, it seems like it's a handleable problem. But I do think it's something that we need to be very attuned to, because as we saw, conditions can change quickly, and they could propagate across other institutions, and that's something that we need to be focused on.
Well, this time went really fast. I've let one more question.
Okay.
And it's a simple one. What do you think we learned from the pandemic?
I think the main thing I learned, I can't speak for everyone, is how when you work together, you can actually get through things together. And I think that's a lesson I take, because it was remarkable. I can tell you in the bank, it was a remarkable effort to really try to understand what was going on in the district, in the national economy, and what we could do, given our toolkit, right, to really help. And I think that happened each and every, your firms, I'm sure that was the same thing. You know, what can we do to get through this? And not only for you, but all the households of your employees. You know, if you're a household, what could you do to help your neighbor? I think that was a remarkable lesson.
That's a positive note to end on. Join me in thanking President Mester. Okay, just a few things. I do want to thank my partners in this endeavor. First of all, Loretta, who, by the way, is a fellow of the National Association for Business Economics, so she stepped up. I'm representing NABE and the Cleveland chapter of NABE here today. I had a ton of help by lots of people. Team NEO, of course. Jack Kleinhans, who is sitting over there, my old colleague at the, not old, former colleague at Cleveland Fed. Rob Rich, who is the director of the Center for Inflation Research. So if you haven't been to that webpage, get there. It's tons of great work. I'm really jealous of it, so I hesitated to call that out, but I did anyway. And all of the team on Cleveland, on the Cleveland staff, who are fabulous. All of you, kind of, would you stand up and be acknowledged, please? They're also very shy, apparently. And thank you all for coming. It wasn't the most perfect day to show up, but we really appreciate it. I will follow up with a survey to see if we can kind of keep some element of this association kind of going. I think CABE was the oldest local chapter in the country of the National Association for Business Economics. It was the first and the oldest. How are those? Are those independent observations? Gotcha. Thanks very much for coming. We're adjourned.